So this is a question of limited company where you have to make an entire income statement. Along with the income statement, they've also asked you to make a statement of financial position. This has come in October, November 24, paper 21. If I just have a look at the question is something like that, which has a full trial balance, a list of 9 adjustments, and they've asked me to prepare a statement of profit and loss. And when I look at the statement of profit and loss, I realize that it is in the form of IAS 1. Are you with me? Okay, fine. So this is in the form of IAS 1. After that, they have given me place for working notes where they want me to put my workings. They have asked me to calculate the balance of cash and cash equivalents. And then they want me to make my statement of financial position, which just has the equity, which is having the equity, my liabilities, non current liabilities, and current liabilities. No assets? No assets. Okay, fine. So now, when I am making my income statement, the very first thing that I go and see and I do is I will always do my markings. The main important thing in income statement is you need to do your markings. You need to see where which things are going so that you're very clear. Markings is very important. And having to know the year end is also very important. Let's do the markings. Financial year end of T Limited was on 30th of June 2024. This is my year end. Okay. First item 8% bank loan. Whenever there is a percentage given, that means the first thing would be there would be interest, hidden adjustment. They tell us, they do not tell us. I know this interest should be there, and interest on the bank loan normally becomes a part of the finance cost. So I am putting my marking as FC. Okay. Now I have bank loan. Bank loan is non current liability, and interest on bank loan is finance cost. I'm just marking the things. Administrative expenses goes as AE. Since when we read the question, we had heard about cash and bank balance. Yeah. Normally, bank overdraft is a part of current liability and cash would be a current asset. But when I was reading the question, I came through cash and cash equivalent. So, one thing to remember over here that cash and bank balance would be treated as cash and cash equivalent. Do not be in a hurry to write the things. Essential thing, first step, do your markings. Okay. Carriage inward would be a part of your cost of sales. Distribution cost would be distribution costs, finance costs. Okay. Fixtures and fittings, they go in the non current assets. They help us to find the depreciation. So I have the cost and provision for depreciation. This is opening inventory, would go in the cost of sales. Land and building non-current assets, motor vehicle non-current assets, purchases goes in cost of sales. Retained earnings would go in your SOCE. Revenue would be revenue only, it will go in your income statement, it's sales. Share capital will go in SOCE. Trade payables is current liability, trade receivables is current assets. Another important thing to note over here is once you do your stuff, you need to mark it out whether it is done or it is not done. Okay, let's do the first very thing over here. The adjustments we will read and we will see what goes where. So, our very first adjustment tells me goods were delivered and were invoiced. Invoiced means what? It was sold. So, good was delivered and it was sold to a customer on sale or return basis. What do you mean by sale or return basis? Sale or return basis means whenever you're selling the goods on sale or return basis, the goods are going out. Yes? Whenever I sell the goods on sale or return basis, the goods are going out, but it can only be considered as sales when your customer approves it. Okay? So when you delivered the goods, it was a part of your sales, but I cannot treat it as sales unless my customer does not confirm it to me. Okay? So goods were delivered and invoiced to the customer on sale or return basis. These goods had selling price of how much? These goods had the selling price of 12,000 and there was a markup of 25%. Okay. Then they are selling on the last date. Inventory was counted and valued at 86,400. So they have given me information about closing inventory. And they are saying that on this last date, that means on the same day, my customer informed that he had not decided to keep the goods. So the two effects for this would be, what would be the two effects of these? This is sale or return basis. The customer has not yet approved of the goods. So the two effects of the sale of return basis would be, I am going to remove from sales. Okay, I'm going to remove from sales the selling price. And the second effect of this would be add to closing inventory. Add to closing inventory at cost price. Okay. What happened over here is when you sold the goods, when you gave him the goods, you wrote it in your sales, assuming that the customer would buy it. Now the customer is telling that he has not yet intended to buy this. So you are going to remove this from your sales at the selling price. Okay, I'm going to remove it from the sales at the selling price, and now these goods belong to me. Okay, the goods that are sold on sale or return basis, these goods are now belonging to me. Since these goods belong to me, I need to add it back to the closing inventory. Try to recall the meaning of closing inventory. Closing inventory means goods that are unsold. Okay, they're still lying with me, and closing inventory is to be recorded at cost or NRV, whichever is lower. I hope you are with me. Now I will see what to remove and what to add. So I have to remove 12,000 from the revenue at selling price. Okay, so I will go to my revenue. I will go to my revenue and I will remove 12,000. What will I say? This is sale or return sales. Yeah. And I will add to my closing inventory. The closing inventory over here 86,400. I have to add the goods that are sold on sale or return basis at what price? At cost price. Now the question over here is what is the cost of the goods that I have to add back? 12,000 is the selling price, isn't it? Okay. So markup. Markup is on. So I have markup 25%. So I would say 25% is on cost, but I do not have the cost. So I will put on sales. This is one fourth on cost. It will become one fifth on sale. What is the selling price of the goods? One fifth on 12,000. So I would say 12,000 divided by 5. So this is going to give me 2,400. Please note markup and margin gives me the profit included. Profit included in the selling price. So 2,500 is the profit. Selling price is 12,000 minus the profit that is included over there. So I will minus 2,400. So the cost of the goods would be 12,000 minus 2,400. The cost of the goods would be 9,600. So 9,600 is added to the closing inventory. So 86,400 was there before and 9,600 I'm adding it. Okay. With this, I know that I have to prepare workings as well. Yeah. I have to prepare workings as well. So I will go to my working section and I will write. I don't see the sections over here. Okay. So I will write in my first working note was for revenue and my working note number 2 belongs to cost of sales. So because I know my working note number 2 belongs to cost of sales, what will I do? I will write cost of sales is what? Opening inventory plus purchases minus the closing inventory. When I will see, I will add. I don't know right now. I don't remember. We just marked it, right? Okay. So my closing inventory was 86,400 plus the goods that are sold on sale or return basis. How much is it? 9,600. So my total closing inventory would become 86,400 plus 9,600. My total closing inventory becomes 96,000. Okay. Now, this adjustment is incorporated. I'm cutting it off. Yes, correct. If I want to cut the adjustment in full, I will take my revenue and I will put it. So my revenue is 705,100. My working note number 1 was for the revenue. Yeah. So my revenue was 705,100. Add the sale or return because it, sorry, I'll remove the sale or return because this is no longer a sales. So minus the sale or return 12,000. So this becomes how much? Sorry, 693,100. So this is already done. I have taken from here. I have completed and I have completed my full adjustment number one in all aspects. Are you with me? And what I completed, I am knocking it out. Okay, fine. Now comes the distribution costs. Second adjustment. It includes a charge of 3120 for motor insurance for the year ended 30th November 2004. So I'll make a working note number one was this. Working note number two was my cost of sales, which is down. I'm taking my working note number three. Working note number three is distribution costs. Okay. Let's see distribution costs. Next to my distribution cost, I'm putting working note 3. Next to revenue, working note 1. Next to cost of sales, working note number 2. I hope you're with me. Since I'm taking this, I will take this amount of distribution cost, which is already there, 114870. Now, what are they saying with regard to distribution cost? Distribution costs includes a charge of 3120. Remember this, a small hint or a link. Whenever there is something that is included in the adjustment, they say, that means the effect of it would be that you have to exclude it. So whenever anything is included, you exclude it, and whenever anything is excluded, you would include it. Okay. So let's see what it includes. It includes a charge of motor insurance, but this charge is for the year ended 30th of November 2024. Okay. So this includes motor insurance, which is paid up to 30th of November 2024. What does this mean? I know my year ends on 30th of June. Okay. So I would minus motor insurance. Yeah, I was thinking. Year ends when? Year ends on 30th of June. I have to make a statement up till where? I have paid up till where? 30th of November. Year ends in 30th of June, but I have paid insurance up to the 30th of November. That means July, August, September, October, and November. 5 months is 5 months is prepaid. Yeah. So this 3120 is paid for 12 months, but my prepaid is for 5 months. Three one two zero into 5 divided by 12. 1300 is prepaid. So I would say 114870 minus the 1300. So what I'm getting is 113570 up till now. I hope you're with me. We've not yet finalized it. How about the things? What will we do? What is the other effect of prepaid expenses? Other effect of prepaid expenses is it's a prepaid expense. So I removed from here where it is prepaid. We are following the matching principle. The other effect is it is a current asset. It is other receivables. So if I am making my statement of financial position, I should keep this in mind. I hope you're with me. Now I'm going to my adjustment number two. Now adjustment number two is recorded, right? It is recorded in the working note. Please remember that you need to go from your working note to your income statement for sure. You need to go from your working note to the income statement. So be mindful of it. Now I go to the next adjustment. I also have to minus the distribution cost. Next adjustment says there is an irrecoverable debt of 540, which has to be written as administrative expenses. Can you tell me what is this bad debt? Is it old or new? Anything that is given in the adjustment would always be a new bad debt. So I am putting my working note number 4 now, which is related to administrative expenses. I hope you are with me. They are telling me that this bad debts is to be written off as administrative expenses. So when I am going to administrative expenses, the first thing that I would do in my income statement, I would write this as working note number 4. I will go to the administrative expenses. I will take administrative expenses. I will strike it off over here. What I'm already given is 131,310. I hope you're with me. Now I have an irrecoverable debt of 540 that has to be written off as administrative expenses. This is new bad debts. They told me that new bad debts is a part of administrative expenses. Okay. Normally, when we are preparing an income statement, we always do for new bad debts. It is old plus new. We see if there is any old bad debts over here. You will not find over here because they have given us the trial balance in the form of IAS 1 only. That means if there was any old bad debts, it is written over. Okay. What are the two effects of new bad debts? First, you write it as other expenses. Correct? So I wrote it as other expenses in my working note for administrative expenses. And second effect of new bad debts is you have to remove it from your trade receivables. So I have my trade receivables over here. I'm minusing my new bad debts, 540. I hope you're with me. So with this, I am making my working note number 5 for my trade receivables. What is my trade receivables? 69,740 minus new bad debts, 540. What I get is what? What I get is called the net trade receivables. This makes it 69,200. I hope you're with me. The next adjustment says, adjustment number 3 is recorded. Next adjustment says, directors have decided to create an allowance for irrecoverable debts. Okay, they have decided to create an allowance for irrecoverable debts at 5% of my trade receivables. So, provision for doubtful debts, how much percent? 5%. Provision for doubtful debts are always created as a percentage of your net trade receivables. So, minus provisions 5%. 69,200 into 5% is 3,460. If I am ever supposed to make the statement of financial position, the trade receivables that would appear in my statement of financial position would be 69,200 minus 3,460, that is 65,740. I hope you're with me. This is the new provisions. What do I do with my new provisions? What do I do with my new provisions? I don't do anything with my new provisions. I will go and check old provisions. Then I say old minus new. If it is positive, it is other income. If it is negative, it is other expenses. So I check old provisions. Nothing there. Okay. So I don't have anything in old. Old is 0. New provision is 3,460. So old minus new, 0 minus 3,460. I'm going to get a negative 3,460. So this is other expenses. Come on, bad debts are treated as a part of what? Administrative expenses, they've already told us over here. Yeah? So 3,460 is to be charged as administrative expenses. Charging me, sir? So we are supposed to charge provisions at 5% of your net trade receivables. Okay. Now, if you look over here, when we sold our goods on sale or return basis, normally when we sell our goods on sale or return basis, unless otherwise mentioned, there is an assumption that these goods are sold on credit. So when I sell the goods, whether it's normal sales or whether it is on sale or return basis, and this thing is already recorded, it would have been added to the sales and it would have been added to your trade receivables. When I sell the goods on credit, I add it to my sales and I add it to my trade receivables. Whether it is our normal sales or whether it is a sale on return. Whether it is a normal sale or whether it is a sale on return, I add it to sales, I add it to trade receivables. When I sell it, when the goods are going out, I always assume I'm so confident that my customer is going to buy the goods. Okay? But in this case, what happened is that my customer did not confirm that he's going to buy or not. So the effect that I have to put is I have to remove from the sales the selling price. I have to remove from the trade receivable the selling price. And I have to treat these goods as my own. So I will add it to closing inventory. I will add it to the closing inventory on costs. The mistake that we did over here is we remove from sales the selling price. We remove from the closing inventory the cost price. But we forgot to remove from our trade receivables. So first I have to remove my sale or return. We forgot this. So I have to remove my sale or return, which is of 12,000. So from 69,740, first I remove my sale or return. Then I remove my new bad debts. So I get my net trade receivables as 57,200. Yeah. From 57,200, I take 5% provisions. So this is 2860. So 57,200 into 5%, 2860 minus equal to my trade receivables to be shown in my statement of financial position would be 54,340. Are you with me? We do not have any old provisions, so old minus new was negative. If it is negative, it will go in our other expenses. So it is adding up to my expenses, the new increase in provision for doubtful debts. How much? 2860. We are doing all of this in our working note. Please be mindful of it. So we finish adjustment number 2, we finish adjustment number 3. We are done with adjustment number 4. I'm going to adjustment number 5, which says administrative expenses are outstanding 680 on the last date. What do I do to my outstanding expenses? So anything that is outstanding, it is yet to be paid. So I add it to my expenses. Other effect for outstanding expenses, it is a current liability, it is other payable. So if I have to make my statement of financial position, I have to be mindful of this. So 680 would be added to other expenses. I'm not supposed to make my statement of financial position which covers the asset section, so I can avoid this. So what will I do? I will add the outstanding administrative expenses, which is 680. Please note, I'm doing adjustment by adjustment. Okay. Everything is being solved in the working note. Everything is being solved in the working note. So we already completed our adjustment number 3. 3 was the irrecoverable debts. Adjustment number 4 was for provision for doubtful debts. Adjustment number 5, outstanding expenses. What we had forgotten to record was our sale or return. We forgot to remove it from our trade receivables. So it is very important that the effects are, known 1, 2, 3. The next part says adjustment number 6. It is related to debentures and bank loan. I'm just scrolling through. Adjustment number 7 and 8 is related to depreciation, and then there is taxation. Okay, let's go ahead with the next adjustment. Adjustment number 5. On the 30th of June, what is 30th of June? It's our last day. Yeah. T Limited took 5% debentures of 45,000. Let's try to work out the effects of it. So on the last date, I have taken debentures, 5% debentures of 45,000. What does this mean? I've taken a loan. Okay, first thing. Second thing, this is a non-current liability. I remember that I have to prepare the equity and liability section. So I am writing over here 5% debentures so that I don't forget. So I write 5% debentures. I write in the non-current liability 45,000. I hope you're with me. Okay. I've taken a loan. Loan is for 45,000 and the interest is 5%. Whenever percentage is there, interest is your hidden charge. Okay. Tell me, since this loan is on the last date, will I have to charge interest? Pay interest, I mean to say. No interest is supposed to be paid. Fine. Now, second thing, we only thought from the point of view of one adjustment. One adjustment is that we are taking loan. I hope you're with me. We are taking loan, so a liability has increased. It's a credit effect. What would be the debit effect? Can I say money is coming in? I issued debentures, that means I've taken loan. I've taken a loan, a liability has increased, the credit has increased, credit effect. Money is coming in. Money is coming in. So debit, what will I debit? I will debit the bank. Bank debit. That means when I am preparing the cash and cash equivalent, this 45,000 would be added. How do I know I had to prepare the cash and cash equivalent? I just scroll through the question. Yes? Now I go ahead. So I have done my two effects for debentures. Money coming in, I added, and debentures, I have to record it in the NCL if I am to record, and I wrote it in my trial balance. Then I go ahead. On the same date, the company has repaid one half of 8% bank loan together with 3 months outstanding interest on 30th June. Wow. Okay, let's break this up. Okay, I have bank loan on the same date. So when they say on the same date, that means on the 30th of June itself. On the same date, company has repaid, paid back one half of 8% bank loan. Half of 8% bank loan. So I go and see my bank loan. My bank loan is 54,000. It is 8% bank loan. Apart from that, they are telling me over here that this loan was taken in 2024. I don't know the date yet, and no date is given to me yet. But I know one thing, that this loan, half money was paid. So 57,000 divided by 2, 28,500 was paid. So I'm writing over here. If it is paid, means what? If it is paid, means what? Money is going out. Hmm? So I will remove it from cash and cash equivalent. I'm writing minus 28,500 bank loan paid. I hope you're with me. Sorry, how much it is? 27,000. Sorry, my bad. So 27,000 is paid. Okay. Since this 27,000 is paid, so I should remove my bank loan and I should reduce it, that now only 27 is to be paid. Very well. and it is paid together with 3 months interest outstanding. That means they are telling us that this loan was taken 3 months before, and this 3 months interest is outstanding because I don't see any other interest mentioned to me over here. So 3 months interest outstanding. So I would say I have an outstanding interest 54,000 into 8% into 3 by 12. So this becomes 1080, and this 1080 is also paid. So if it is paid, I will write minus paid. Okay. This interest is paid. I remove from cash and cash equivalent. What is the other effect? Interest on bank loan. Interest on bank loan. It's a interest charge. Interest is a finance cost. Interest on bank loan, interest on any other thing, it is a finance cost. So I would go to my finance cost. When I'm going to my finance cost, I will first write my original finance cost, that is 5180. Now this expense is increasing. Add interest on bank loan 1080. Can you just analyze the situation and tell me what are these people actually doing? They took a bank loan in 2024. They took this loan, it's just been 3 months. It is 8% bank loan. Yeah? Then what did they do? They paid half of this loan and issued debentures of 5% for 45,000. Why they might have done this? Bank loan is how much percent? They are repaying this because the interest expense is more. And they are taking debentures 5%, interest is less. They're repaying 27,000 and taking another liability of 45,000 with a lesser rate of interest. When interest rate is more, you pay more interest on loans. When interest rate is less, you pay less interest on loans. You're trying to save your costs. That's why they took debentures, and that is why within 3 months they've repaid the bank loan. Am I clear with this? So let's see if we've done everything. Everything for debentures was done, liability created, bank out. Everything for bank loan done, half bank loan paid, cash out, interest put in the finance cost, and the bank loan reduced. Okay? They said none of these transactions are recorded in the books of accounts. We already know that these transactions are recorded and not recorded in the books of accounts. That is why it is a part of my additional information. Now, our last part, that is related to depreciation. Now, our eighth and ninth adjustment is pending. This is our last part that is related to depreciation. They say, I saw one more adjustment on top, which I might have missed up. Yeah, adjustment number 7. Okay, what are they saying? Land and building, it includes our land for how much? 60,000. So I have three assets over here. I prepare my working note number 6 for depreciation. I prepare my working note number 6 for depreciation. And if I see, I have all the three assets being depreciated. Yeah. So since I have all the three assets to be depreciated, I would start with the first information, that is land and building. Land and building has land that cost 60,000. We always know that land always appreciates, it never depreciates. So, and they are also telling us for information that land is not depreciated. So, I have my land at building at 165,000. This includes 60,000 for land. That means my building is how much? That means my building is 105,000. If my building is 105,000, land and building is to be depreciated at 2%. 105,000 into 2%. So 2,100 is the depreciation for land and building, and this is a part of administration cost. The very moment I do this, I will go and record it. I have administrative cost working note number 4. I will add depreciation on land and building. How much? 2,000. 2,100. 2,100. Okay, I've done a mistake. It's going to go in the distribution cost. So this is going to be a part of distribution cost. I go to my distribution costs. Have I made a section for distribution costs? Yes, I have. So I will add in the distribution cost the expenses, that is depreciation on land and building, 2,100. Yes. The other effect of this is I'm going to add to the provisions 2,100. Suppose I have to make my asset section. So depreciation is added to depreciation in case I am depreciating. Provision for depreciation is a sum of the depreciation charged over the years. Okay, so I have done it immediately. Come on, depreciation on land and building is sorted. Next is what? Fixtures and fittings, 10% reducing balance method. Reducing balance method means on the written down value. So I would do cost minus depreciation. Cost is 16,200. Depreciation is 9,560. So the net book value, or I would say my reduced value, is 16,200 minus 9,560. So the reduced value is 6,640, and the depreciation for the current year is at 10%. So it is 664. Okay. So 664 is a part of administrative expenses on fixtures and fittings. I will go to administrative expenses and I would write depreciation on fixtures and fittings. 664. I've got this from working note 6. Where else will I go and add this depreciation on fixtures and fittings? In the provision for depreciation. I hope you're with me. The next part is depreciation on motor vehicle, reducing balance method. So I would do 82,000 minus 34,590, cost minus provision. It's 47,410 into 20%. So this is 9,482. Motor vehicle is distribution cost. Depreciation on motor vehicle is distribution cost they have given us. Distribution cost, I have it over here. Motor vehicle, this is working note number 6. Distribution cost, how much? 9,482, right? Yeah. And the last adjustment is taxation is 26,000. So I'll take the taxation and I'll put directly over here 26,000. I know taxation is subtracted. I hope you're with me. With this, we've completed all the adjustments. Now, what I have to do, I have to take all the working notes and start incorporating my final answers. Okay. So we have to start incorporating our final answers. Let's take interest on bank loan was a part of the finance cost. What I see over here, I first have the administrative cost. I can just add it up. 13,130 plus 540 plus 2,860 plus 680. This is 17. Okay. 131,310 plus 540 plus 2,860 plus 680. So this is giving us 135. Is the same amount that I'm adding? 664 I have not added. Have I missed out something? Furniture and fittings reducing balance method. Yeah, so I forgot to write it over here. I wrote it over here. So the amount is coming up to 136,054. So this is the administrative expenses working note number 4. Please put it over there in the administrative expenses. How much it is? Okay. I'll start from here. Bank loan is NCL. Okay. Administrative expenses is done. Cash and bank would come in bank and bank overdraft. Now I have bank overdraft and cash would come in cash and cash equivalent. I have carriage inwards 820. Let's see what we've done for carriage inwards. Were we making a cost of sales? Yeah. So I have carriage inwards. I'm taking this working. I'm taking on top for your convenience. Come on. So our cost of sales, we have opening inventory how much? 93,400. I have carriage inwards I have carriage inwards 820. Do I have purchases? I have purchases. Opening inventory, carriage inward. I have purchases 293 780. And I already did the working for my closing inventory. So my cost of sales is 292,000. So 292,000. Yeah. My revenue, I have this total 693 100. I don't see anything else that is related to revenue. Yes. Okay. The cash and cash equivalent looks very gachpach, gachpach. I'll just move it. Carriage inwards done. Distribution cost done. Finance cost done. The three assets are done. Purchases is done. If I have to make an SOCE, I will look at retained earnings, but for the moment, not. Yes? Okay, for the moment, not. I have nothing else. I would try to look at adjustments. Come on. This is giving me gross profit 401 100. Now I have distribution costs. I will go to my distribution costs adjustments. It's over here. So this is 114 870 minus 1300. Yes, plus 2100 plus 9482. Yes. So I'm getting a total of distribution costs for 125 152. Yeah. So distribution cost is 125 152. I'm doing the finance cost also over here. Finance cost is 5180 plus 1080. It is 6260. And administrative expenses is, it's done, right? Administrative expenses. So distribution and finance costs are the two things that I need to take up. Anything else? We'll get to know. So I have distribution cost how much? And finance cost 6260. Okay. This we got from our working notes. So my profit from operation, gross profit minus distribution cost minus administrative expenses. My profit from operation comes to 139,894 minus the finance cost. We'll get profit before taxation 133,634 minus the taxation. I'm going to get my profit for the year 107,634. Income statement is made. Yes, income statement is made. I go to the next part. What am I asked? So this is because I am doing it on a tab. The thing looks like this. But if you're not doing on your tab, you're doing in the book, it would be much easier and convenient for you. Now, I have to calculate my cash and cash equivalent. Cash and cash equivalent means cash and the bank. So let's start. It's for 4 marks, so be mindful. I have bank overdraft as 12,380. It is a negative balance. Then I have cash 240. After that, I took debentures. I've written it over here when I was doing. plus 45,000. Then I gave a bank loan, 27,000. And then I also paid interest on bank loan, 1080. So my cash and cash equivalent is coming up to 4780. I hope you're with me. Let's go to the C part. Now I have to prepare equity and liabilities, statement of financial position. Fine. I would start again from the very first item, bank loan. Bank loan is a part of bank loan is now going to be repaid in 2024. It's written 2024. Okay. So that means it should be repaid in 2024. I'm on 30th of June. I'm in 30th of June. And they are mentioning in the bracket 2024. That means I'm going to repay full by 2024. So this becomes a part of my current liability because it's going to be paid within 6 months. So 8% bank loan 2024 is 27,000. I hope you're with me. So I scroll through, this is not there, bank loan gone. Cash and cash equivalent is current assets, I'm not interested. Non-current assets, non-current assets, no. Retained earnings, 38,450. You should remember over here that whatever profit I make for the year is added to retained earnings. It increases the retained earnings. So what was my profit for the year? So my old retained earnings was 38,450. I will add the profit for the year. What was the profit year? So profit for the year increases my retained earnings. So 38,450 plus 107,634. So 146,084. Okay. So in my equity, I would write share capital 80,000, no increase or decrease. Then I would write retained earnings 146,084. Retained earnings done, share capital done. This will not come. Then I have 5% debentures. Non-current liability 45,000. My total equity is 226,084. My liabilities, current liabilities. Trade payable is a part of current liability. Trade payables is 32,160. And for taxation, they had said that it is to be paid. Is estimated to be 26,000. It is estimated to be 26,000. That means it's not yet paid. It's other payable. So current liability. 26,000 is my taxation. So my total liabilities would be 45,000 plus all of this. Yeah. What? Yeah, we do. So outstanding expenses would be, I'll add it in trade payables and other payables. So this is 32,160 plus there was an outstanding administrative expenses. How much? Here. So it is 32,160 plus 680. So this becomes 32,840. So this is 32,840. Very alert you need to be. So my total liabilities is coming up to 130,840. So total equity and liabilities would be 356,924. Okay. How do you get total equity and liabilities? Which all part you will add? This is your total equity. This is your total liabilities. So total equity and liabilities would be 356,924. Come on, the theory part of this now. Assess the director's decision on the 30th of June to take out the 5% debentures. That means he's issued 5% debentures. Justify your assessment by considering advantages and disadvantages. Tell me what happened. He has repaid the bank loan. He has repaid the bank loan by 27,000. He has taken debentures of 45,000. He's repaid the 8% loan and taken debentures of 5%. Justify. What is it done good or no? Let's see. He's removed the negative cash balance. Apart from that, he has removed the loan that was to be paid at a higher rate of interest and it was due to be repaid within the next 6 months. That means 2024 was the last date. Okay. There was one mistake that we did before is we thought that the loan is taken in 2024, but it had to be repaid by 2024. 3 months interest was outstanding. That means the 3 months that has already been paid would have been included in the finance cost. There was this one mistake that we did. Another advantage is that the debentures has a beneficial interest rate compared to bank loan. Bank loan has 5% interest rate, debenture 8%, and debentures has 5%. So there is a beneficial interest rate. I hope you're with me. Okay. Next part, disadvantages. He's taken debentures for more 5 years. See where debentures are from 28 to 29. So that means he's tied the company into more expenses for more liable, more interest expense for 5 years. Okay. When you're taking loan, that means you're weakening your capital structure of the company. Loan is more, own is less, own funds are less. So you're weakening the capital structure of the company. And when you're issuing the debentures, you might have to pay interest for more 5 years. So less profits for another 5 years. According to me, he's done a good thing because he's bringing liquidity. So the director has made a wise decision by bringing in more cash flow. With this, we complete this sum. which is of October, November 24, paper 21. When you're doing this sum, you have to be very mindful. 30 minutes is the maximum time you can give. Okay? This is your only challenge. That's it. If you like the video, like, comment, subscribe.